All right, what's going on? Terry James, your mortgage guy, coming to you. Today, what I'm going to be talking about is how to refinance your home. What are the major types of refinance and looking at those refinance options. And so, typically, when you go to refinance, what are the three types? It's either going to be, usually, it's going to be a rate and term refinance, a cash out, meaning you're taking money out of your home, or they even have, if you have a FHA, VA, or a VA loan, you can even do a streamline refinance. And so when we're looking at rate and term, what does that mean if you're doing a rate and term refinance? So the rate and term refinance, you're pretty much going to be looking at, for example, if you're just looking at changing your current rate, taking into the up-to-date current market rate that at that time that you're refinancing, or you're changing your term, which is going from like a 30-year to a 15 or a 20-year term. And so just to give you an example, for example, if you have an interest rate today at 6%, 6.5%, whatever it might be, and 2 years from now, the market goes down, interest rates are at 3-4%. Okay. Of course, I'm not saying they're going to get there, just throwing numbers out there. So let's say they go down to 3%. So in 2 years, what you would do is, for example, when you go rate and term, you're saying, hey, I'm going to take the new rate at 3%. And at that point, 2 years later, you're going to say, hey, let me do either another 30-year term, or you can even look at doing like a 25, 15, or even a 20-year term. And so, a lot of people think that because you go into that term and, you're doing that because, of course, you're dropping your payment down from 6% to 3%. And yes, technically your term or the length of time that you have left on the mortgage does kind of change. It does change. But the advantage that you get from going from 6% down to 3%, even if it's a 30-year, you're going to save on your mortgage payment. And so that's typically why most people do a rate and term, refinance, and why it's beneficial to look at doing that at that point. Now, most people typically will do, for example, most people are going to do, when you refinance, you go into another 30-year term because you're able to get the lower payments. So that's how you get the lowest payments, is by going to a 30-year term. Now, the one thing that a lot of people, sometimes get caught up in, or what they look at, they say, oh, I've been paying this mortgage for 4 or 5 years, and now to go back, they feel like they're losing as far as something to go from, they got 25 years left to go into a 30-year and extend it out 5 years. Now, what a lot of people might be thinking is that, hey, my amortization goes up. I'm paying more interest because I've added on another 5 years. You've already been paying. However, when you really look at the amortization chart on a mortgage, the first few years, you're going to look at, if you've been in it for 2 years, and now let's say you have 28 years left, when you compare the interest of 2 years later, adding on another 2 years, okay, because you're going from 28 years left to a 30-year, some people think that extends how much interest you're paying. But when you look at the monthly payment that's being saved, oftentimes that will outweigh the back end of from 28 years to 30 years. So that's where you just got to look at it, look at the amortization chart at that time to really see which one would be beneficial. You may even consider at that time to do, for example, if you have 28 years, maybe you go into a 25-year term. Just know that when you shorten the term, your mortgage payments increase, because now you're paying it off in 20 years or 25 years versus 30, so your payment goes up. So even at that time, even if you take the lower rate in 2 years, just giving an example, and the rates, let's say it's at 3% in 2 years, you're dropping down from 6 to 3, that payment on a 25-year term or a 20-year term may be more, or equal to what you're paying on the 30-year. So that's where you have to weigh your options on which one is better, because you have to look at, okay, what's my payment now, what is it going to be. But one thing I would say, that when you're looking at a rate and term and you're looking to refinance, one thing that I personally would look to do is all day, give me the 30-year. If I'm going to change my term, give me the 30-year. I mean, to be honest with you, I would take a 75-year mortgage payment. Whatever it might be, extend that sucker out as long as it's possible. Because, the thing is that you want the lowest payment possible. A lot of people say, oh, I want to pay my home. Well, look, you can pay your home off at any time. But the advantage of having the lowest payment possible today, what you can do with that extra money, now you're able to use that, and who knows, you can now start investing in other things that's going to earn you money. Okay, so now you start leveraging your home, take the lower payment, now you can use some of that by savings. Now you can start to invest in other things, no matter what that is. I mean, if you save $1,000 a month by going to another 30-year term and extending it out, that is $12,000 a year, that you can invest in, whether it be certain stocks that are, I'm not talking those hot stocks, but certain companies that are pretty strong, that consistently earn back dividends, or even if you're looking at dropping into your mortgage, or if you're an entrepreneur, what can you do with extra $12,000 a year? Maybe you could use that money, put it back into your business, and generate more money from that $12,000. So those are some of the options that you want to look at when you're looking at refinancing rate and term. A lot of people get caught up in saying, I don't want to reset my mortgage, but hey, I'm of the mindset, give me the lowest payment. I'll take what I have now and see if I can make more money with saving that extra $500,000 a month. And you can always have the advantage later when your income increases. You can start throwing more money on that principal mortgage. So those are some of the things that you definitely want to take advantage of and start to look at. So the reason why you want to look at the interest and saving that money when you're doing a rate and term, why you may want to extend it out and not be worried about what happens on the back end so much, is because, especially depending on the type of income you have, if you have an income that's based on commission, or you have other sources of income coming in, you have some flexibility with your income. One of the things you can do is you can beat what the interest might be on the back end. So let's say you extend your loan out from 28 years or 25 years, you do another 30-year mortgage, extend it out another 5. Well, if you can invest what you're saving, you can beat the back end of the 5-year that you did extend. So that's why you want to look at, all those different things. You can beat the interest that's going to be earned on the extra 5 years. You may be able to beat that with the income by leveraging what you're saving to use that. Now, when we talk about a cash out refinance, when you're talking about cashing out, you're saying, okay, I want to take money out of the home. Of course, whether you do a rate and term or you're looking to do a cash out, you're going to need equity in the home. So that means that depending on what your loan amount is versus the value of the home, you need the equity in your home. So typically when you're looking at a conventional mortgage, if you have a conventional loan and you're looking to do a refi either out of it, or you want to go from FHA to a conventional loan on a cash out situation, typically the max loan to value is going to be 85 to usually 90%. Typically is going to be your max loan to value. So when you're strategizing and you're saying, okay, I want to refinance, I want to pull some cash out, you want to look at these numbers. And I'm talking about primary residence. So if this is your primary residence, the conventional loan, on a conventional loan, the max cash out going to be about 85, 90%. What that is basically taking your current loan amount, you can add that to the cash that you want to take, divided by your value, and that should get you your loan to value. So that should get you your loan to value. And so that's going to be the max that you have So that will be the max loan to value that you have available to take out to use if you're pulling cash out. So typically, as a good rule of thumb, if you're taking cash out, because there is going to be some fees for refinancing, so I would say a good rule of thumb is typically 30%. If you have 30% equity, that's a good time to look at taking your cash out if you plan to leverage that and perhaps buy another property, or you plan to leverage it and invest in something else that's going to earn you money. You typically want to have about 30% loan to value on a single family home, primary residence. If you're looking at a multi-unit as your primary, you're typically going to be maxed out at usually 70, maybe 75% on a 3 to 4 unit property. So you just want to be aware of those guidelines before you go to refinance, or even as you purchase a multi-unit, as you purchase a single family and you're developing your strategy of getting out of this home, whether you're going to be selling it or whether you say, okay, in 2 years I plan to do this, I plan to take money out and do this. So you want to be aware of those cash out guidelines. Granted, they are always changing, but you do want to be aware of those so that you know what your exit strategy is going to be. If you plan to sell the home, you got to know, okay, well, how much equity am I going to have? What can I leverage? If you plan on taking a cash out, like we're talking about today, cash out refinance, those are some of the things that you want to begin to look at. Now, the other option, as far as typically, is going to be more of a rate and term when we're talking about like FHA, VA, streamline process. Now, the reason why these are pretty great and why they're available to you if you have an FHA loan and a VA, typically they are going to be done through your current mortgage lender. So you want to contact them if you want to do a streamline. And the reason why is because typically you won't have to pay a appraisal. No appraisal would be done. And usually income docs are at a bare minimum if you even have to sign any at all. The streamline process is just changing your rate and changing the term. So what that means is that, you're in a FHA loan at 6%. Rates today are down at, like, we'll say 4%. And now what you can do is that what you're doing is you're going to call up your current lender. You'll say, hey, do you have a streamline option available? They pretty much will just probably send you over a package for you to sign. You probably don't even have to update any income docs. And once you sign that, you're saying, hey, I'll take the 4% now. I change my new loan term. I go from 28 years. I go back into a 30-year or 25-year, whatever terms you agree to. And that's as simple as a streamline process. So those are only available for FHA, for VA loans, but that is another refinance option. All right, but any of those things, if you have any questions, feel free to comment. Leave me a message, DM me, contact me. I'll be glad to go over any other options for you in regards to refinance and some of the things to look for. Take care.